$13.09. This one, at the start of the current year, Blue Corporation, the calendar year taxpayer, holds accumulated E&P of $100,000. Their current E&P is $60,000. At the end of the year, they distribute $200,000 to 100 each to equal shareholders, Pooja and John. Their basis in the stock is $11,000 for Pooja and $26,000 for John. All right, so I'll pull up my little worksheet again. See if we can get some. Let me see if I can go over a little so maybe I can see some more even columns. Okay, I might have just a little bit more. So let's make sure we have the data set. Oh, here, I don't need all that. State board, no, thank you. I don't think so. Hang in there. I just minimize just for a second. Hang on. Okay, I lost myself there for a moment, but I'm back. Okay, so now we've got these two shareholders, Pooja and John. They own equal shares of Blue Corporation, and there's E&P accumulated of 100 and current year of 60. So what we got is 100,000 current. That's the first place we would go to try to see if we should report dividend, and 60,000 for accumulated. I'm sorry, current is 60. 100 is the accumulated. For a total between the two, 160, and they equal shareholders. So we'll divide it by 2, and we'll see how much each of their allocated piece of E&P is. That's not what I want. Eventually, there we go, 80,000 piece. So then we look at the distributions, and we see the distributions are 200. So they're 200, 100,000 each. So of these, we see that we are, because they are both positive, we're going to show that there's no negative, and there's only one distribution for the year. We're going to show, you wouldn't have to come up with a partial allocation of the year or anything like that. No, it's not complex like the one we previously did. So this one is just that they have 80,000 in E&P each between the cumulative and the current, or the accumulated and the current. And so it's pretty straightforward. The dividend income in both cases is going to be $80,000 because that's their share of the combined E&P. Okay, so that piece we know already because that's the standard way when both are positive and there's only one distribution. Okay, so we're going to use that 80,000 as the dividend amount, and then we're going to have a return of capital and a capital gain. And so the return of capital part is just their basis. So they don't even ask you to tell them the answer to that, but you kind of have to know what the return of capital is, but they tell you their stock basis, which is the same thing that the return of capital would be for. So each of them got 100,000. So for Pooja, $100,000, and she had basis of, what is it, 11,000? Yes. So she's going to have, she's got a $20,000 gain minus I wish I would have just went ahead and subtracted that, but I'm going to. Maybe, if it'll let me go back and edit it. It doesn't want me to edit. I can't see my formula bar, so I'm going to have to start over with that one. That's okay, I can do it. All right, so I got a $100,000 distribution, and the E&P part that's already been reported is 80. So let's just seriously, I don't understand why you're being mean to me. Okay, come on, you can do it. All right, so let's go this way. We'll just move over a little. This is the part that's like her showing up as her. It's going to produce her gain. $20,000 we have to deal with. That's in excess of her E&P, and she's got $11,000 basis. So it's really straightforward. It's just my fingers aren't cooperating. So a $9,000 gain. And that puts her with the next question, what's her basis? She used all of it up, so she's got 0 basis. So she used all of it, that's why. And so what's going to happen with him, this is Pooja, and this is John, and his basis is 26,000. So that negative just means how much left of his basis. So basically he has no capital gain because he's still using his basis. He was able to offset the $20,000 extra that came in with his basis. So he still has a $6,000 basis. So what happened is Pooja got $100,000. And since her basis was only 11, she had to show a capital gain of $9,000 and she has no basis left. And then John had a basis of $26,000. He had a $100,000 distribution, 80 of which shows as a dividend because it's this E&P share. And then he used up 20,000 of his basis to offset that. So he had a return of capital of $20,000 with no capital gain and a $6,000 leftover basis. But that one's pretty straightforward, not complicated. All right. Let's see if I get some more columns for another time. In case we need it. I bet we will. Tends to be the kind of thing you need some calcs for. Okay, so this one is problem 1314. And this one, let's go ahead and get a little bigger. Sparrow Corporation, a calendar year taxpayer. At the beginning of the current year, Sparrow holds accumulated E&P of 33. Corporation incurs a deficit in the current year of 46,000 that accrues ratably throughout the year. On June 30th, Sparrow distributes $20,000 to its sole shareholder, Libby. If Libby's stock basis is $4,000, how is she taxed on the distribution? They want to know what's the taxable dividend, what's the return of capital, and what's the capital gain. Okay, so let's see what we can do with this one. We're going to have this little calculation box. So what I said was, okay, the accumulated E&P was 33. Our current, as of the date of the distribution, June 30th, was half of this. This is the year's deficit. So half of it is 23,000. You see that? So she had, let's go ahead and go back to the right column with this. She's going to have to reduce her accumulated by this 23, which is half of the year. 6/12, thinking of it that way. 6 months of year deficit. Okay, because they said it was, this loss was accrued ratably over the year. That told you just divide it by the number of months, or look at the fact that it's June 30th and say it's half a year, same deal. Okay, so that leaves you with a net E&P after those calcs of 10,000. Seriously, in the wrong place. Still have my undo button where I can reach it. That's nice, but it's not working. But other than that, it's great. There we go. I know I could have done a sum instead. $10,000 is the net E&P. And then we have this distribution that is at 20,000. Is that what it was? Look here. Oh, $20,000 distribution. So 10,000 of the distribution is going to be a dividend because that's what her net E&P is. The next 10,000 is going to be either a return of capital or capital gain. So looking back at her basis, they said her basis was 4,000. So that much of it is return of capital. And the other 6 is her capital gains. If they ask you what her ending basis is, it's 0 because she used it all up. She only had a $4,000 basis and she used it for this return of capital right here. And she was left with a capital gain of 6,000. So she had every kind of income from this distribution, right? But pretty straightforward. This is one of my favorite problems because it's like reasonable. One more, 1315. Now this one's a pain, but it's not unconquerable. It's just a pain. Complete the following schedule for each case. Assume that the shareholders had sufficient basis in the stock, meaning it's not going to be a capital gain. All taxpayers use the calendar year. Thank you. All distributions are made at year end except for E. So assume that $130,000 distribution is made on June 30th. The corporation uses the calendar year for tax purposes for Part E, just Part E. The rest of them are all calendar year basis. So we'll assume these are 5 separate cases. They do not accumulate. So, or they're not necessarily related at all. All right, so 130 in December, in June is the anomaly. The rest of them are all at the end of the year. So if you look at, they gave you the beginning earnings and profit, they gave you the ending earnings and profit, they gave you the distribution amount, and they want to know how much is dividends. So looking at this one, we can use the current earnings and profit to offset 70,000, to decide how to classify 70,000 of the 130. And the remaining 60 is going to be a return of capital. You don't combine them. When you have a negative E&P accumulated and a positive current, you use the current. You start with current and try to use it first. Okay, so that's pretty close. All right, so let's see. Looking at this one, the next one, we have a negative current, which means we have to combine them. And when we do combine them, we wind up with 30,000. So we get a 30,000. We have a $30,000 combined E&P, looking at previous years and the current. Only when the current is positive can we just go ahead and take it as a dividend. But so when it's a combined total and it's positive, but it has to be netted. So 30,000 is all we have in net. So because our current loss has wiped out some of our accumulated. So we can take 30,000 and the remainder is going to be, and all these assume it's just one payment. It's at the end of the year, 180,000. Is that too many zeros? No, that's right. Okay, then the third scenario, we have positive on both sides, 160,000 total. That means there's no question about it. There's earnings and profits to cover all of the distributions, so they're all dividends. And there's no return of capital. Then the D scenario, again, we got this loss for this current year. That means we have to net them together. It's a total of 60,000 when you combine the previous accumulated to the current loss in E&P. So we wind up with a $60,000 dividend amount, and the remainder of the 130 is return of capital. Again, they told us their basis was sufficient to handle any of these transactions, so there's not going to be a capital gain in these scenarios. Okay, so that last one, a bit of an issue, meaning we have to do that little gyration. So this one, 120,000 what we came in with, then 60,000 at June 30th, only half of this would have been in effect. So only 30,000 has to net. The loss of 30,000 has to net with our 120. So when you take 120 coming in as the accumulated E&P and add only half of this, because it's only June 30th now when we're making this distribution. So then we wind up with 90,000 as the dividend amount, and all the rest is coming in as return of capital. So once you do that difficult problem that we started with, then this is not difficult, but it's still a pain because they're different scenarios and you got to look at them and see what is the ordering of this E&P for how it's going to apply as dividend versus return of capital. So it's not rocket science, but it is going to take you a little concentration to get this right. So there's going to be a homework problem, I think, like this one. I'm not sure there is, but there could be. And I need you to understand it well enough that if it shows up on the test, you would know, or some piece of it showed up. Okay. So that's the last one of these in-class examples that I want to show you. And we will come back with some more information later.